Welcome back, everyone. I'm your course administrator, and on behalf of SNB experts, I'm pleased to welcome you to Module 13. Today, we are undertaking a deep dive into the world of financial ratios and credit analysis. This is one of the most critical skill sets for any finance professional. Financial ratios are the vital signs of a business. They tell us about its health, its efficiency, and its ability to survive in the long term. Throughout this 12-minute session, we will move beyond just the formulas and focus on how to interpret these numbers like a seasoned credit analyst would. Before we look at the slides, I want you to think about financial statements as a story. Every line item has a purpose, and every ratio we calculate helps us read a new chapter of that story. Let's start with our learning objectives to see what chapters we'll be reading today. Our roadmap for this session is comprehensive. We'll start by mastering the calculation of liquidity ratios. From there, we'll move into profitability metrics and assess the solvency and leverage of a business. This is essential for understanding credit risk and a company's ability to handle its debt load over the years. We will also measure operational efficiency, test for covenant compliance, and identify those critical early warning signals of financial distress. By the end of this module, you'll be equipped with a framework to conduct a complete ratio analysis from start to finish using consistent professional standards. Now, as we move into the 4 categories of ratios, I want to emphasize consistency. You must use the same formulas and time periods to get a meaningful comparison. In your Excel models, always link directly to your financial statements to avoid manual entry errors. To conduct a complete analysis, we generally group ratios into 4 distinct buckets. First is liquidity, which addresses short-term health and a company's ability to meet immediate obligations. Second is profitability, which focuses on earnings performance and how efficiently a company converts its efforts into bottom-line returns. The third bucket is solvency, which looks at long-term stability and the capital structure of the business. Finally, we have efficiency, which measures asset utilization. How well is the company using what it owns to generate revenue? Using all 4 categories together provides a holistic and unbiased view of financial health. I often get asked which category is most important. The truth is, they are interconnected. Poor efficiency often leads to liquidity issues, which can eventually threaten solvency. That's why we look at them together, not in isolation. Let's dive deeper into our first category, liquidity. Liquidity ratios are about safety. The current ratio is your primary indicator, comparing current assets to current liabilities. We also look at the quick ratio, which is more conservative as it excludes inventory, and the cash ratio, which is the most stringent measure of all. Finally, working capital shows the absolute buffer in dollars. A general rule of thumb is that higher ratios indicate better short-term health. However, as an analyst, you must ask why. Is a high ratio due to a healthy cash balance, or is it because inventory is sitting on the shelves too long? The composition of these assets is just as important as the final ratio itself. In the real world, liquidity can disappear overnight. That's why lenders look so closely at these numbers. They want to know that if things get tough, the company can still pay its suppliers and short-term debts. Let's look at how we calculate the most common liquidity metric, the current ratio. The math is straightforward. Current assets divided by current liabilities. Let's look at this example. If a company has $5 million in current assets and $3 million in current liabilities, we get a ratio of 1.67. This means for every dollar of debt due in the next year, the company has $1.67 in assets to cover it. Interpretation is where the real work begins. A ratio of 1.67 is generally considered a good liquidity position. It provides a reasonable cushion against unexpected cash needs. However, you'd want to compare this to last year's performance. Is it improving or is it declining? Trends are your best friend in credit analysis. Once you're comfortable with liquidity, the next step is looking at profitability. A company can have plenty of cash today, but if it's losing money every month, that cash won't last forever. Profitability is the sustainable engine of any business, and we need to understand how well it's running. We analyze profitability through margins and returns. Gross margin tells us about production efficiency, while operating margin looks at how well the company manages its overhead and operational costs. These ratios allow us to compare companies of different sizes within the same industry to see who is truly more efficient. Return on assets and return on equity are the ultimate measures of performance. ROA shows how well management is using all assets to generate profit, while ROE focuses specifically on the return generated for shareholders. High returns are great, but we must use a framework like DuPont to see what's actually driving them. The DuPont analysis is one of those pro tools that every serious analyst should master. It's essentially a way to take apart a clock to see how it works. Instead of just seeing a high ROE, we can see if it's coming from high margins, fast turnover, or simply high leverage. Let's look at the formula. The DuPont framework breaks ROE into three manageable components. First is profitability, measured by the net margin. Second is efficiency, measured by asset turnover. And third is leverage, measured by the equity multiplier. By multiplying these three together, we arrive at the final ROE figure. This breakdown is incredibly revealing. For example, if a company's ROE is increasing, but its net margin is falling, you can immediately see that the increase is being driven by higher leverage or better asset turnover. This insight allows you to ask management the right questions and assess the quality of their earnings. Now, as we move into section 13.3, we're shifting our focus to the long term. Solvency ratios are about survival. Can the company withstand a downturn? Can it continue to meet its debt obligations year after year? This is the heart of traditional credit analysis and where ratings are born. We track leverage through debt to equity and debt to assets. These show the balance between owner financing and creditor financing. We also calculate interest coverage, which tells us how many times a company can pay its interest expenses from its operating profit. In general, lower debt ratios indicate lower financial risk and a stronger credit profile. Lenders often set specific targets for these ratios in their loan agreements. These are known as covenants. If a company's debt levels creep too high or their interest coverage falls too low, they could find themselves in technical default. That's why monitoring these solvency metrics is a monthly requirement for many finance teams. When it comes to solvency, debt to EBITDA is the king of metrics. It's used by everyone from local bank managers to global rating agencies to decide if a company is investment grade or speculative grade. Let's look at how these ratios map to real-world credit ratings and what they mean for a company. This table is a great reference for your own analysis. A ratio below 1.5x is typically seen as excellent, leading to AAA or AA ratings. As the ratio climbs, credit quality drops. Once you hit the 4.0x or 5.0x range, you're entering weak or distressed territory. This ratio literally tells you how many years of cash flow it would take to pay back all debt. Think about that for a second. If a company has a 5.0x ratio, it would take 5 full years of their current earnings, assuming zero growth and zero spending, just to clear their debt. That leaves very little room for error. This is why investors demand higher interest rates for companies with these higher leverage ratios. It's a direct price for risk. We've covered a lot of ground, from short-term liquidity to long-term solvency. But there's one more piece to the puzzle: efficiency. How well is the company actually working? Are they turning inventory into cash quickly, or is money getting trapped in their operations? Let's look at section 13.4. Efficiency is about velocity. Inventory turnover tells us how many times a company sells and replaces its stock in a year. AR turnover measures how quickly they collect cash from customers. We often convert these into days, like days sales outstanding, to make them more intuitive. The faster these cycles move, the less cash a company needs to tie up in its day-to-day operations. Asset turnover is the high-level efficiency metric. It tells us how much revenue is generated for every single dollar of assets on the balance sheet. A rising asset turnover ratio is usually a sign of improving management and operational strength. If you see this falling while revenue is rising, it might mean the company is growing inefficiently. One of the best ways to see efficiency in action is the cash conversion cycle. It's a single number that tells you how long it takes to turn a dollar spent on inventory back into a dollar of cash in the bank. It's a critical concept for managing a company's working capital and ensuring they have enough liquidity to grow. The formula is a simple 3-step process. Add your day's inventory. outstanding to your day's sales outstanding, and then subtract your day's payable outstanding. For example, if your total cycle is 50 days, it means your cash is tied up for nearly 2 months before it comes back to you. The goal for management is always to shorten this cycle as much as possible. As an analyst, look for companies with a very low or even negative cash conversion cycle. This is a massive competitive advantage. It means they're essentially using their suppliers' money to fund their growth. This level of insight is only possible when you look at efficiency and liquidity together. It's a powerful way to spot operational excellence. We've reached the end of our technical tour. We've covered the metrics, the formulas, and the interpretation. But remember, the numbers are just the start. Your job is to take these numbers and provide a recommendation. Is the company healthy? Is it worth the risk? Let's wrap up with the big picture and our best practices. In summary, Module 13 has provided you with the tools to assess financial health through 4 key lenses: liquidity for the short term, profitability for performance, solvency for long-term stability, and efficiency for operational strength. We've also learned about the critical importance of covenant testing and monitoring early warning signals to catch distress before it's too late. Always remember to use multiple years for your analysis to identify trends, and always compare your findings to industry benchmarks. A ratio alone is just a data point. A ratio in context is an insight. Use your Excel tools to keep your analysis consistent and documented. This holistic approach is what separates a good analyst from a great one. On behalf of SNB experts, I want to thank you for your time and focus today. Mastering these concepts takes practice, but the rewards in your professional career will be significant. Please subscribe to our channel for more modules and training content from the SNB Experts platform. This is your course administrator signing off. Goodbye, and see you next time.